Hello, market is opening tonight, and we are here going to introduce to you our second part of the Infinity stocks. For this part two, we have actually named it the Incredible Hawk.
Whoa.
Okay, before we start, let us first introduce ourselves. Hi, I'm Joe.
And I'm Sarah.
We are husband and wife team, and together we aim to give you the most balanced analysis because we believe together we are better.
And together includes all of you. Before we start, here's just a small disclaimer. The stocks that we'll be sharing with you about is really purely based on our own research and our conviction about the businesses. And we are sharing this purely for educational and discussion purposes, and these are definitely not stock recommendations. Please do your own due diligence before taking any actions. This is a continuation of our Infinity Stock series, and we have 6 Infinity stocks that we would like to share in this whole series, and this is part 2. Joe, can you remind us what makes the Infinity stocks?
Okay, sure, of course. Okay, the Infinity stocks, first and foremost, they must be companies with very, very strong moats and fundamentals. Because there are 6 stocks, so overall, this mini portfolio must have a level of diversification. Okay, what's more important is that the share price will be affected by the trade war, but we believe that the intrinsic value of these companies remain. Alright, so therefore, the trade war presents a very, very good opportunity to cause the stocks to be undervalued.
Wow, and the trade war doesn't seem to be ending soon, which means that this continues to present us with good opportunities to get good businesses at undervalued prices. Wow. Okay, so for those of us who missed it, please go and watch part 1 of our series where we introduced 2 ETFs that we have been adding to our watch list during this time of the Infinity Wars or trade wars. Okay, you can also subscribe to our channel so that you do not miss any videos from us. So Joe, why do we call this the Incredible Hulk series? Is it like the Incredible Hulk in the Marvel series?
Got to get out! Let me out! Let me out!
Wow, so scary. Bruce Banner grew to more than 2 times of his size, no, to be the Incredible Hulk. But funnily, his pants can still fit.
Yeah, don't know why.
Okay, anyway, Joe. So, where are you? Come and tell us why you call this the Incredible Hulk series? Wow, how come you are green in color? What happened?
Okay, actually, I'm not turning into the Incredible Hulk, neither am I sick. I've just managed to find some growth stocks which I believe can grow like the Infinity Hawk.
Wow.
Sorry, the Incredible Hawk.
Wow, okay, but Joe, can you not turn into the Incredible Hulk? It's quite scary.
It's okay, you see, I can still manage to keep my shirt intact, not like the one in the cartoon.
Okay, Okay, so Joe, what makes the growth stocks?
Okay, in the business life cycle of any company, there's always these 4 phases: the startup, growth, maturity, and decline. For us, we believe that these companies that we are going to introduce to you, they are still very much in the growth phase, and therefore we can expect them to grow quite fast.
Wow, which means we are also going to be expecting quite a high rate of return with these businesses.
Yes, definitely.
Okay, so what's the first growth stock you have on your mind, Joe?
Okay, is this particular company, Alibaba? You can rub the genie, okay, but this is not that one. Okay.
Okay, so ticker symbol BABA for those of you who are interested to invest in this stock.
Alright, so what is the core business of Alibaba? Of course, they are in core commerce, cloud computing, digital media entertainment, especially Youku. Okay, one thing that I would like to point out is actually Youku is equivalent to the YouTube in China.
Wow,
so it is
that's
definitely
massive.
quite big.
Wow, massive.
Alright, and of course, they also dabble in innovation technology. AMAP is one of the most highly used navigation maps in China, equivalent to our Google Maps. And they also come up with this Tmall Genie, which is China's version of Google Home.
Wow, sounds like a very, very strong business. But Joe, can you show us why you would consider this as a growth stock from the financials?
Okay, sure. Alright, first and foremost, okay, many growth stocks actually do not pay dividends. Why? Because they would rather use the money, the earnings that they collected to actually continue to grow the company, which makes sense because they are in the growth phase. They need the money for expansion. All right. And if you look at Morningstar, Alibaba's EPS over the past few years, you see the lowest was 36.2% over a 3-year average. So that is, while it has come down, that is still considered quite high.
Wow, that's more than 30% growth or in terms of the earnings for this company. Wow. Okay, but Joe, I heard that during this time of the trade war, right, Alibaba stock price like went down quite a lot, no? Don't you find it risky? Like ever since the trade war was declared, wow, the stock price actually plunged by almost 50 points. That's quite risky, right?
Okay, remember what did we say just now? The trade war actually gives us a very, very good opportunity to buy because it will affect the share price. So I will consider that to be very natural. So if you ask me why Alibaba, okay, let's go through the modes. In terms of intangible assets, I think Alibaba now is quite a household name. All of us should know Taobao. In fact, a lot of us go to Taobao to buy cheap items, furniture, from everything from furniture to electronics. Okay, there is definitely a low cost advantage because, like what I said, they are in the cloud computing business. They are right now the largest cloud computing service provider in the Asia Pacific. Of course, with this, they are able to purchase components in bulk. And imagine Asia Pacific, all the data is stored in Alibaba's cloud computing service. Do you think if the companies want to switch, do you think it will be so easy? Definitely. So therefore, I believe the high switching cost is there.
Wow, it would be really a pain in the neck, no, to switch all my data to another cloud or another like hardware system.
Yes, definitely. Okay, the third one, okay, this to me is the most solid mode. Okay, I believe that Alibaba is the most solid matchmaker. How they do it is they actually try to attract sellers into their platform, and with a lot of sellers, buyers will come in because now you have a platform that can buy so many things. You have so many varieties, so many options. And when there are more buyers, what happens? Sellers start to come in. Do you see that this is actually like an infinite loop where the more number of buyers attract more buyers? Sorry, the more number of sellers attract more buyers, and subsequently, more buyers attract more sellers. It's
Wow.
never ending.
Wow, so that's like they are forming like the infinity loop.
Yes,
Wow.
all right. And very interestingly, if you look at the financial reports of Alibaba, they actually spent 1.757 billion to purchase 10.7 million shares in 2018, which works out to be 144 USD per share. So if it hits the price, watch out.
Wow, okay, so Baba must have like quite a lot of confidence in their own company to repurchase their shares. In fact, they repurchased 10.7 million shares, no? And USD 144 should be a fair price that the company considers to get their stocks at.
Yes, so if it hits 144 again, do see this as an opportunity.
Wow, it looks like we're almost there. The stock is already at 154. And in fact, right, during this 6-month period in 2019, there was a point in time where the stock, right, actually hit 130. Wow. And it looks like the stock is going to continue to move downwards, which means we may have the opportunity to get it at 130. And during this 2-year period, the stock has actually reached a resistance of 190 before. And if we get the stock at 130 and if it really grows to 190 as depicted in the charts, wow, that is a potential growth of 46%. What an incredible hawk. Wow.
Yes, definitely. And the next growth stock that we are going to introduce is Facebook.
Joe, can you show us from the financials why you would also consider this as a growth stock?
Yes, sure, certainly. All right, again, Facebook does not give any dividends because we believe they still need the earnings to grow. And if you look at the growth, they actually grow at an average rate of 40%.
Wow, year on year, which means they have been growing like 40% more year on year. Wow, that's really huge. But recently, right, there has been a lot of bad news on Facebook. So I'm also wondering whether is it risky, Joe? Like, ever since the tighter regulations happened, like the stock price has also been plunging downwards. What do you think, Joe?
All right, I really see this as an opportunity.
You mean even when it plunged as much as 9% to a 3-month low, and in fact, it's the worst performing name in the tech-heavy Nasdaq index, you know?
To me, the more the better. Why? Okay, actually, Pete, if you are in the BOS group, Pete also actually uploaded a video talking about Google, Amazon, Facebook. If you are interested, do go and check the video out. I believe that will give you more insights to these three companies.
Okay, so you still believe in the business of Facebook even when the stock price has plunged to this level?
Definitely. In fact, okay, Facebook has a very, very strong trinity of WhatsApp, Facebook itself, and Instagram. I mean, who doesn't use these three applications now? Okay, if you look at it, there was a 14-hour service disruption of Facebook services, including WhatsApp and Instagram, on March 14. In fact, I was really, really hoping that the share price would drop, but it didn't happen. Okay, just ask yourself, do you think would happen if other companies had disruptions of a similar scale?
If these other companies didn't have that strong a moat, right, I'm sure their share price would have plunged a lot already.
Yeah, so what does this tell me? It tells me that investors are quite confident in Facebook. Even when the disruption happened, there was no mass panic, there was no major sell-off.
And it's quite true, right, what Pete mentioned in his video, that even though all these regulations are in place, it does not really affect the core business of Facebook actually.
All right. Of course, if you look at the financial reports again, Facebook actually came in and they repurchased their shares at an average price of $168.
Joe, really? $168?
Yes.
We are already there. The share price is already at $167.50. Wow. And within this 2-year period, I mean, if we were to look at the very first support line, yeah, it actually reached a low of 148 before. And looking at the downtrend of the stock, it may very well give us an opportunity to get it at an even lower price of 148, which means we would have beat Facebook's own average buy price. Wahaha. And if we look at these 2 years, one of the resistance points would be at $190. So if we were to get the shares at $148 and it appreciates to $190, wow, this is a potential growth of 28%. Another incredible hawk. Wow. Okay, so guys, these are the two incredible growth stocks that we have for you today, Baba and Facebook. And do stay tuned for part 3 where we will be having our finale.
Okay, do stay tuned. Let us know in the comment sections what you think. And we believe together we are better.
Alright, till next time where we introduce our finale. Bye.
Bye-bye.